Hi there. Let's assume that we are living in a world where there is no government or financial institution. To survive, we have to consume. Someone from the household take initiative to establish the farm. We call them entrepreneurship or organization. All resources owned by the households, farms hire the factor of production from this household, like land, labor, and capital. So household actually provide factors of production to the farms. By using this factor of production, like land, labor, capital, and itself, household also act as a organization or entrepreneur. Farms produce goods and services. So we assume that the farm produces by using all resources in a given year, like 5 kg rice and 5 kg wheat. For simplicity, we can define that the farm produce 10 units of output by using these factors of production in a given year. Then what happened? Farm will actually distribute this output because there is no money or financial institution there, so price will not exist. So all economic activities will be conducted by actually in real units. What farm will do now? Farm will distribute this output as a factors of payment among different factors of production. So there is 10 units of output. 3 units of output landowner will receive as a rent. Similarly, those household, those they are providing labor, they will we are assuming they will receive 2 unit of output as a wage. And the capital, those who own the capital, they receive their payment as interest, and we are assuming that that is also 2 unit. It is called interest. The total cost of production is like 3, 2, and 2, that is 7 unit. That means the profit that will receive by the entrepreneur or organization is still 3 unit. What we are seeing that like household providing factors of productions to the farm. By using this factor of production, farm produce 10 units of output and distribute it as an income, and that will receive by the household in the different form as a rent, wage, interest, and profit. That means household receive the income or factors payment. And if we sum this or add all together the factors payment, we also see that is 10 unit. Or we can say in other way that household will make consumption. That means because this is the real unit, that means those who own the land, they will consume 3 unit of output. Similarly, those who provide labor, they are actually consume 2 units of output. Those who have capital, they will consume two units, and as an entrepreneur, they will consume 3 units. This diagram shows that how economic activities actually conduct when there are two sectors in the economy, and we see that the relationship between farms and household. Now, if we extend our model by adding more two sectors, like we are adding financial institution and government. The role of government is actually to redistribute the wealth from different sector in order to maximize social welfare. And the role of financial institutions here is to make the household income that are actually not spending, and household make it a saving to the financial institution, and financial institution actually convert this saving into investment to the farm. So now we're assuming the same thing. Household provide the factors of production to the farm, and by using these factors of production, the farm actually produce 10 units of output, 5 kg rice and 5 kg wheat. Because there is money in the economy and there is also government, we can give the nominal value because the price now exists. So let's assume that each unit of rice we can sell by $10, and similarly price of per kg wheat, that is also 10. For simplicity, we are assuming that. We see that now market value of the all final products that the economy is produce is actually uh, rice added value $50, and wheat will be added value $50. So the total output, if we measure in the monetary term, that is actually $100. We can define this actually the GDP, gross domestic product. That means the farms produce by using all its resources in a given year, and this is the final sale value or monetary value, and we call this actually GDP. So now we are not distributing the physical unit, instead we are distributing the money. So we are assuming that land will receive, instead of 3 unit of output, they may receive $30 as a rent. Similarly, labor receive $20, and uh, capital, that means interest payment, is also $20, and rest of the is profit, that is $30. Now the factor payment is actually, that means household receives the income which is not 10 unit of output, that is now converted into $100. Now there is a legal restriction, so household cannot spend its all money income. So before spend any income, any dollar, household should pay the government as a portion of its income as a tax. So household will actually pay tax to the government, and we are assuming that is 10%, that is $10. And what government will do, government actually make the spending. So when government make decision to spend this money, so that will actually received by the farm. So any spending if we are making in the economy, that actually finally the destination is farms. That is, government will make the government spending. The government spending is $10 also. So rest of the money the household can spend for either consumption purpose, or they can also use for savings to the financial institution. If the consumption is, we assume that $70, so all household make consumptions, that is $70, and rest of the income household will save to the financial institution. So we are calling this savings, and which is $20. What financial institution will do? Financial institution actually convert this saving and give loan to the farm. So that means we are calling this investment, which is also $20. So if we see that the farms use households factor of production, land, labor, capital, and organization, and by using these factors of production, farm will produce 10 units of output, and its monetary value is 100. So that is actually called national income, and we can measure it by three different way. First is like the final output, how much value that is added. So we see that 5 kg rice added $50, and 5 kg wheat also added $50. That is the final sale value of all goods and services that is produced by the economy in a given year. So that is 100, and we call this approach to measure the national income is value added approach. And we can also measure this GDP or national income by another two approach. That is, one is income approach. If we are adding the factors payment in a given year, then we also get the national income. And another approach is like, if we adding the all spending in an economy in a given year, like here consumption, uh, investment and government spending. So if we are adding this, so 17, 20, and 10, that is also 100. So that is called expenditure approach. So till now we are assuming that the economy is actually closed, so we are not allow any international trade. So if we allow international trade, then what happened? The farm will selling some portion of its output uh, to the others country, and we are calling this export. So by exporting uh, good and services, the household will earn some money. Yeah, and what household will do? Household spend some of their money to import from others country. If the economy is open, then we add another component as a expenditure, like which is called net export. So which is the distance between or difference between the volume of export income minus the import expenditure. So that will add it in the expenditure approach when the economy is open. That give a brief idea about how the different sectors of economy actually interact, and how can we measure the our national income in different approaches.